Welcome, everyone, to this explainer. Today, we're taking a wildly fun yet absolutely crucial journey into the world of personal finance. We're going to break down some of the most complex, headache-inducing concepts of wealth building, and we're doing it using a brilliant primate-themed metaphor, the primate's guide to wealth, planting your banana tree. If you've ever felt completely overwhelmed by financial jargon, or if you just want a crystal-clear path to building your future, you're in exactly the right place. Let's get right into it.
So here's the core problem. Monkey want banana. But how does monkey get many banana? It's the universal question, isn't it? We all want to build wealth and secure our financial futures. But getting there? Well, it often feels like trying to navigate a dense, dangerous jungle filled with confusing acronyms and fast-talking finance gurus. We desperately want the end result, but the actual process seems incredibly intimidating.
Now, what's really interesting about this slide is that the ultimate foundational secret to all wealth is delayed gratification. In our jungle metaphor, leaves represent our money, and bananas are the goods, services, or wealth we eventually want. Look at week 1, you water your newly planted banana tree, and nothing happens. Week 2, you diligently water it again. Still nothing. Week 3, literally nothing happens. This exact moment is where most people just give up, but 40 years later, boom! 1 million banana trees. It beautifully maps out how building wealth is never an overnight event. It's a long-term practice of supreme patience.
So, let's clearly define what this watering process actually is. Investing is simply putting leaves, your money, towards anything a monkey thinks will go up in value in the future over a long period. It's taking a small amount of the resources you hold in your hand today and planting them for tomorrow. The fundamental truth we're exploring in this explainer is that small, highly consistent amounts of money invested over a very long timeline yield massive, almost unbelievable long-term results.
Moving on to Section 1, the primate's dilemma, saving versus investing. You might be wondering, well, why plant the tree in the dirt at all? Why shouldn't our monkey just hoard all their extra leaves in a safe, secure monkey bank and call it a day? This comparison pretty much tells the whole story of why hoarding just doesn't work. On the left side, we have leaves sitting in the monkey bank. Your leaves just sit there, lonely and sad. They don't grow. But guess what? The bank isn't just letting them sit in a vault. Oh no, the monkey bankers actively take your money and invest it to make a massive profit for themselves. Sometimes they invest in nice things, sure, but often they're sinking your hard-earned leaves into things like gasoline made from fossil fuels, tobacco, or even gambling. Meanwhile, look at the right side. If you actively choose to bypass the bank and invest your own leaves, they actually have the potential to slowly and surely grow in value for you, not the bank.
And this brilliantly illustrates the silent wealth killer, inflation. If you just save your leaves, you actually lose purchasing power because bananas get 3% more expensive every single year. Your safely hoarded leaves buy fewer and fewer bananas as time marches on. But if your investments grow at, say, 6% per year, you're actually outpacing the rising cost of those bananas. Investing is really the only reliable way to beat inflation and ensure your leaves maintain and grow their true real-world value.
That brings us to Section 2, the monkey's headache, active versus passive investing.
So there are two radically different paths our primate can take here. On the left, we've got the active strategy. This is the primate who watches 30 hours of YouTube videos on technical analysis, pores over corporate bank statements, desperately tries to perfectly buy the dip, and stays up scrolling through stock subreddits until 6 a.m. The result? Total exhaustion and a massive headache. Now, let's look at the right side, the passive strategy. This monkey simply invests 10 leaves every single week, no matter what the stock market is doing. They set it, they forget it, they go outside, and they actually enjoy their life in the jungle. This leads us to a massively important concept, dollar cost averaging. It's essentially the passive strategy of investing regularly, no matter what the stock market is doing. Now, I should mention, it's absolutely vital to understand that both active and passive strategies carry inherent risk. The market can and historically has crashed entirely. Monkeys don't always know if the dip is actually the bottom. But this passive method, it's infinitely more accessible, vastly less stressful, and incredibly effective for beginners trying to enter the market.
Section 3, assessing the jungle, the investment tier list. Okay, let's dive into this, because different assets carry very different levels of risk and reward.
Not all banana trees are created equal, right? Here we have our comprehensive risk versus reward tier list. At the absolute top, S tier, we naturally have bananas, rare, highly valuable, always a classic.
Now jumping down, let's impartially look at B tier, gold. It historically protects against inflation, but it doesn't actually pay you any dividends. C tier is crypto, like Bitcoin. It's incredibly complicated and highly volatile, meaning wild price swings. D tier is real estate. It can provide great passive rent, but it's pretty risky and requires a massive amount of upfront capital. Down at the bottom, E tier, individual stocks. Trying to pick the single next big winner is almost always more work than it's worth. But what about that A tier, index funds and ETFs? It's low risk and low immediate reward, but you'll be rich at retirement.
To really hammer home that rock bottom E tier rating, our source material has a fantastic quote. Individual stocks are more work than it's worth unless you're Warren Baboon. It's lighthearted, sure, but it hits the nail right on the head. The data consistently shows that trying to outsmart the market by painstakingly picking single monkey companies is a stressful, losing game for almost every single beginner out there. Which leads us to Section 4, the A-tier secret: index funds and ETFs. If we really want to solve the monkey's dilemma and build wealth without that 6 a.m. Reddit headache, this is exactly where we need to look. An index fund is simply a collection of stocks, such as the top 500 companies in the monkey jungle, all bundled together into one single package. When our monkey invests their leaves into an index fund, those leaves are automatically split evenly across all 500 of those top companies. You aren't committing your entire life savings to just one single banana stand. You're buying a tiny, highly resilient piece of the entire jungle's economy. So the crucial point here is diversification. As you can see, your investment is beautifully split up. Company A, B, C, D, and E all make up a piece of the pie. If one single monkey company completely fails or inexplicably trends on TikTok and then gets abruptly canceled, well, your total overall investment doesn't take a massive hit. The other 499 companies in the bundle keep your overall portfolio stable and steadily growing over time. Now, you might hear the term ETF used right alongside index fund. This comparison highlights the slight mechanical difference between the two. On the left, an index fund has one single set price every day. Nice and simple. On the right, an exchange-traded fund, or ETF, is a highly similar bundle of diversified assets, but its price fluctuates minute to minute throughout the trading day, kind of like bargaining at an open-air market. For a beginner playing the passive long-term game, either of these highly similar low-risk options will do the job perfectly.
Let's bring it all together in Section 5, Execution, Starting Your Banana Empire.
Before we put this into practice, remember we're exploring educational information today, not personalized financial advice. But here is the absolute simplest path to executing the passive strategy. Step 1, budget your leaves. You have to find out what you can comfortably invest while still keeping enough to live on. And, to buy the occasional banana split. Step 2, start small. You can always invest more later when you get comfortable with the process. Step 3, use an app to schedule your investments automatically and then just forget about it. Let it run completely in the background. And step 4, wait 40 years to be rich. It is truly that wonderfully straightforward.
But before we finish up, we absolutely must address the hazards in the jungle. Here are the most common traps beginners fall into that you need to avoid. First, investing more than you can actually afford to part with right now. Second, expecting big, massive results immediately. Remember that 40-year watering timeline. Third, not investing consistently. Fourth, completely panicking and selling everything when the market naturally dips. And finally, falling for get-rich-quick schemes. If an ape promises you overnight bananas, hold your leaves tightly and run the other way.
Which brings us to our final, ultimate question. Are you ready to plant your first banana tree today? The absolute greatest wealth-building tool you have at your disposal isn't a hot stock tip. It's time and your own mastery of delayed gratification. The sooner you start watering that seemingly empty patch of dirt with small, consistent investments, the sooner you allow the undeniable magic of long-term growth to work for you. Take the structured insights from today's explainer, examine your own budget, and ask yourself, what small seed can I plant today that my future self will absolutely thank me for?